Leslie, Pinterest just setting the price range for its IPO. It's going to be offering 75 million shares, expected to price between $15 and $17 per share. And Leslie Picker's been going through this latest filing as we speak. Leslie.
Hey, Andrew, that's right. At the midpoint, that would imply an IPO size of about $1.2 billion. So one of the more sizable tech IPOs than we've seen in recent years. Now, we told you earlier today that this IPO valuation would come in below its latest funding round, which was about $12 billion. Back in 2017, that appears to have been confirmed. If you look at a method of valuing this company based on an apples-to-apples comparison for what it was in the private round, they are seeking at the midpoint of the range just shy of about $11 billion for a valuation, which is a slight discount to where they were at in the private markets. Now, as you mentioned, they are seeking to sell about 75 million shares. The shares outstanding, so on a market cap basis, they say they have about 529 million shares. So on a market cap, and that's what we'll see when these shares begin trading. At the midpoint, we're looking at about $8.5 billion for this company.
What's the high side?
Sorry?
What's the high side?
The high side on a market cap would be...
Did they get to 12?
$9 billion. No.
Okay.
On the high end of the range, we're looking at slightly more than $11 billion on the high end of the range. So, no, they haven't yet gotten to $12 billion, but as we've all learned from these IPOs, it's still very early in the process. This could give them leeway to raise it if they see enough demand from shareholders. But it's also, like we talked about, a psychological benchmark for investors where they may see, even though there really isn't, it isn't an actual discount for them necessarily. They may not view it that way, but psychologically it may seem like a discount because it's at a discount relative to their latest private valuation.
Why would that not be a discount? Why would...
in the sense that if they are the way they value IPOs based on a basket of comparables, it may not be cheap relative to the comparables in the publicly traded markets that they're valuing
but if
it.
it's below the last private round you got, that is still a discount.
It's a discount to that, but they may not see it as a cheap stock. So they may say, okay, well, just because these investors invested privately, they were the ones that were up over their skis, but to me, it still seems expensive. I'm not sure that they'll feel that way, but the way that
who's the they we're talking about?
Institutional investors who are assessing whether they buy these things.
Okay.
So the way they look at it is they will take maybe, I'm making these up as I go along, but like ad-based models like Snapchat and Facebook and Twitter.
That makes sense, right?
Right. And so
it's
then
the private market that may not make sense.
Exactly.
If institutional investors are looking at this.
Exactly.
You don't care what the private market valuation was. You care what the valuation is and how I can try and figure out if that makes sense.
Right.
Based on whatever metrics I get from you and whatever comps I can look at in the.
Exactly. And so that's why institutional investors may look at this price range and they may say, even though it's a discount to their private range, it still seems expensive to me.
I gotcha. I see where you're coming from.
And so that's just all based on how they value it.
Because the question is, were the private markets making sense when they were
exactly in 2017 when they were valued at $12 billion
valuations for Uber and higher?
Exactly. And as we know, a lot of these private valuations have been sky high, and these unicorns have spent years trying to build up their financials to really own up to those valuations.
And still no ratchets or other things in the filing.
Not that I see, but that requires a little bit more of the
we'll take a look.
Cliff notes.